Welcome back, students. We are starting the second semester with this statement, IS-8. So for today, I'm going to explain to you a change in accounting policy. But I know some of you do not exactly understand what a change in accounting policy is. I will try to give you a simplified example, exactly what is it that we are talking about. Right. Now, let's look at this thing. It's just a simplified example of what is a change in policy. So what I've done is I've just trimmed it to a level whereby it just becomes simple for you to comprehend what is happening. Right. Let's take this example. If you buy 10 pens for 5 rand, you'll spend 50 rand. Let's say the price increases by 1 rand after a few days. The same pens now, they cost you 6 rand. Right. So in total, you've spent 110 on these pens. So that is your total value of your inventory. If you are selling these pens, let's assume you are selling it at 10 rand. Okay. Now, the method that you are going to use, remember there's quite a lot of method of valuing inventory. Some they use first in, first out, last in, first out, weighted average. There's just quite a lot of inventory methods that you can use to calculate your cost of sales, your inventory on hand, right? But for this example, let's use first in, first out here as number 1. Just to explain, it means first in, first out, Fifo. Right. Now, let's assume you sell 5. If you're going to sell 5 units at 10 rand, you're going to have 50 rand. Your sales will be 50 rand. Right. Now, since you've sold 5 and the first in are the ones that are going to be the first out, that means your 5 that you are going to sell will come from this batch here, right? The one that I've highlighted. So your cost of sales is 5 units at 5 rand because you've sold 5 units, right? So it's 5 units at 5 rand. That is how much your cost of sales will be. So if 5 times 5, it will give us this 25. So now it's clear that your gross profit is 25 in this case. Okay. Now, if then your gross profit is 25, you must remember cost of sales and gross profit, those are the items that go to the income statement. Okay. Now, once you've done that, it now tells me that you will be left with 5 units from the ones on this date. They are left. Remember, you sold 5, you'll be left with 5, right? Then you'll also be left with the 10 at 6 rand, which is 60. Now, if you add the 2, your closing inventory, meaning the inventory at the hand, the value of it is 85, right? If you are using first in, first out. Now, what then happens if you are using last in, first out? All right. If I'm using last in, first out, my sales will still be 50 rands because I'm selling 5 at 10 rands. Okay. But now, they are saying the last ones that were in are the ones that you must sell first. Okay. So if I sell 5, I will sell 5 from the ones that were at 6 rands. Now, my cost of sales is 5 at 6 rands, which then gives me the gross profit of 20. Now you are starting to see that there's a difference between the two gross profit figures. This one is 25, this one is 20. So the items are the same, but because of choosing a different method, the cost of sale comes out different. The gross profit comes out different, right? Because of that. Now in this one, what is your closing inventory? 5 at 6, because this 5 at 6 is the one that is left, because the first ones that you sold came out from this one. You sold 5 from this one in terms of the last in, first out, right? Then the 10 at 5 is left, which is this one. Now, which then tells me that my closing inventory is 80. Now, you'll see also that the closing inventory is different. If you look at 80, which is the closing inventory here, is different to the 85, right? So now you've got this situation. Same items that we bought, because number 1 chose FIFO, number 2 chose LIFO, it's giving us different gross profit figures, different cost of sales figures, different closing inventory figures. All right. But one thing you just need to know is that if you change cost of sales, obviously, if you change cost of sales, the gross profit will change. Okay. All right. Now, let's then assume that you as a student, you are using number 1. And then you take a decision to say, no, I no longer want to use number 1. I want to change my method, meaning I want to change this policy. Right. I want to move from number 1 to number 2, meaning you were using number 1, but now you want to use number 2. Now, let's start with cost of sales. Remember, a change in policy affects the income statement. It also affects the balance sheet. Okay. Although there's like statement of change in equity whereby you also need to restate, but that one is affected by the after tax of the income statement. Okay. Then I will explain to you how that change comes into play. Now, let's look at this one. If I'm changing from number 1 to number 2, let's start with cost of sales. Look at my cost of sales in number 1 is 25. But where do I want to go? I want to go to number 2. And number 2 tells me that I should be at 30. So for me to move from the 25, this one here, to have 30, it tells me that I must say, okay, 25, how do I get to 30? I must add 5. 25 plus 5 gives me 30. So I must increase it. I must increase my cost of sales by 5. Now you'll see here at the bottom of the page here, I'm saying increase the cost of sales by 5 because I want to move from 1 to 2. Right. So I'm increasing my cost of sales by 5. So I'm going to move from here. Then I will say plus 5. That will give me the 30, this one. Right. I'm going to increase my cost of sales by 5. Now, if you increase cost of sales by 5, so you'll see I've also labeled it here income statement. If you increase cost of sales by 5, the cost of sales is an expense. An expense of cost of sales, if it increases, it will decrease the gross profit by 5. Right. Now, profit and tax, they react the same, meaning they go the same direction. If your profits are decreasing, your tax will decrease also. 1.5 is, so what you'll do, you'll say, okay, my profit is 5. 30% of 5, that will give you 150. This is your decreasing tax. So now, if you say 5 minus the tax of 1.5, it leaves you with a net amount or after tax amount of 3.5, which is still a decrease. Remember, the decrease in profit that is written here, it follows this direction that I've highlighted here. Right. Fine. So once you are done with that part, so you've dealt with the income statement. Although in disclosure, for an example, what I've highlighted, the decrease in gross profit is not supposed to be disclosed in disclosure. You'll see when I show you the note. So for now, for the purpose of this exercise, I'm trying to make it easy for you to follow that this, if you do this, this is what will happen. All right. Now, let's then get into this space now. I've already determined that if I'm here, for me to get to here, I must increase by 5. Right. That is your income statement part that I've dealt with. Now, let's deal with the balance sheet part. The balance sheet part is this 85. I'm at 85 in terms of closing. But where do I want to go? I want to go to 80. So what does it tell me? I must decrease the inventory, meaning the asset called inventory. I must decrease it from 85 so I can get to 80. So how much do I need to decrease this figure by? The 85 by 5. I must decrease the inventory by 5 so I can get to decrease inventory by 5. If I decrease it by 5, I will get to this 80. I will be here. Right. Now, that is my change in terms of inventory. Now, remember, if you've got a decrease in a liability, like here in the income statement, which is income tax or tax expense, if you decrease tax expense, it makes sense that your liability must also decrease in the balance sheet, because if your tax decreases in the income statement, that means the liability towards SARS must decrease also, or some they write it as a tax liability. All right. It then makes sense. I'll explain to you why sometimes we write deferred tax in this line here. Why do we write tax liability? Right. I will show you the line that makes the difference between using this part or using deferred tax in that description. Okay. So your tax will decrease the liability itself in the balance sheet by 1.5 due to this decrease there. Then remember, net decrease in profit, if you've got an after-tax amount of 3.5 decreasing, that amount will end up in retained earnings. All right. And it will be a net decrease in retained earnings of 3.5 in terms of this one. Okay. So I was just simplifying the exercise just to show you how do you go about moving in terms of a change in policy. Now let's then get to the question itself, the one that we are using. Right, before we start, at this level, we're going to have two categories of change in accounting policy that we'll deal with. One is change in inventory valuation method. The next one is a change in borrowing cost treatment. Okay. Now here, they are saying a change in accounting policy is accounted for retrospectively. Now, when we are dealing with a change in accounting policy, is accounted for retrospectively. Let me explain this word retrospectively. Retrospectively means you will calculate the change in policy in the current year, but you must go back and fix the other years, meaning the prior years that you have. Okay, as long as it's practically, then you can fix as much as you can. But the rule is that you fix the current year, then you go back and fix the other years before that. Retrospectively means that it means you go back, you're fixing something backwards. Then there's another word called prospectively. You will see it when we are doing change in estimate. Prospectively means fix this year and go forward. Right. When we're dealing with change in estimate, you'll see we use it prospectively, that one. We account for it prospectively. But a change in accounting policy is accounted for retrospectively. Fix this year, then you go back. Now you'll see it says a change in accounting policy is accounted for retrospectively, which entails calculating both the current year figures, like I said, you fix this year, and the prior year figures using the new policy. Okay, so when you are dealing with a change in policy, you fix it retrospectively. Now here's the question presented to us. So what you then need to do, you need to look at this thing in this fashion. Here, under additional information, they are giving us a table. This table tells us that the old method is last in, first out. You can see it here. And the new one that you want to move towards, or we want to adopt, is this one, the weighted average. Right, they've given you the years there at the top and the amounts. So these figures that they've given you here, these are closing inventory figures, okay? Closing inventory figures, right? So they've calculated them, and they're saying if you were using weighted average, these were the closing figures for those years, closing inventory figures. Using the old method that you are using, these are the closing inventory figures. So they're saying to you, okay, during the year, the company changes accounting policy with regard to inventory valuation from last in, first out to weighted average to provide for a reasonable estimate of cost. Right, I will tell you the relevance of that statement I was reading now, how you use it. Okay. Now, let's get to the calculation itself. How do you calculate it? I've tried to put two calculations here so you can follow whichever method you want to follow. Right. Now, in this table, I've put all the new figures here. For weighted average, the last in, first out is this one. These are the figures for last in, first out. Okay. Now, remember, you want to move from last in, first out, meaning the old one. You want to move from it to the new one. Let's start in 2018, which is this one here. Now, I want to move from 340 to 380. Right. So it tells me that I must increase my inventory, the closing inventory, by 40. You can see the description is given here to say this thing is increasing. The figures that you see in that line, they are increasing. It's not always the case that they will increase like that. Sometimes they go up and down. They increase and decrease. So you must just be careful what you are doing and how the figures are laid out. Okay. So I'm moving from 340 to 380. So my increase is 40,000. In 2019, I'm moving from 300 to 360. My increase is 60. In 2020, I'm moving from 120 to 200. My increase is 80. So all these figures are increasing in this exercise. Okay. So, but don't be fooled by this one, because in some exercises you'll see they go up and down. Okay. Right. Now, usually I advise my students that the first step you must do, you see the figures that are here. Now, the closing inventory is the balance sheet part. Right. It is the balance sheet part. Now, then I move to the income statement part. Now, what I want to do, I want to calculate the cost of sales, this one here. Now, this is the closing, sorry, this is the income statement part. Okay. Now, the first thing I always tell my students is this. I always say to them, look at the figures that are here in this line here. Look at the figures that are here. Okay. And those figures will then have an effect on you. You just take those figures and then you put them here. You put them here. Right. Okay, let me just do this. You put all these figures here. Right. Look at this 80 here and 60. They're here. All of them. You put them there. But one thing that you must always understand is that once you put them there under cost of sales, you must do the opposite of what is happening here. You see here it's increase. If it's increase, you then must understand that in this line here, they must decrease. They are all decreasing, you can see. It's reaching closing inventory, decrease. Because here they are increasing here at the top. That's the first step. Right. Now, because we were not given the opening inventory in 2018, we were just given the closing. So this is a decrease. You can see it's decreasing, closing inventory. But always remember that if something is closing in 2018, it becomes opening in 2019. But the rule is that the sign must change. Remember, when you are doing the calculation for cost of sales, you say plus opening plus purchases minus closing. So it tells you that opening is plus and closing is minus. So if I'm taking 40 here in 2018, which is decreasing, when it comes here, it must increase. When it comes here, it must increase because it must be opposite of what I see in 2018. Right. Right. 60 in 2019 is decreasing. When it goes to 2020, is increasing. Right. Okay. Now I have those figures in the block. If I go to 2018, 0 plus a decrease of 40,000, it gives me a total which is 40 decrease. Here I've got 40 and 60. 40 which is increasing and a 60 that is decreasing gives me a total of a decrease of 20. Right. 60 which is increasing and 80 that is decreasing, it gives me a total of a decrease of 20. Right. Now, let's then analyze this. If I decrease cost of sales, the profits will increase. You must always pay attention that these things are there. The figures, I don't just put figures and I don't explain. Some people must understand that this is a calculation. If you feel that you don't want to write this increase and decrease, only in a calculation, you can do this. You can put arrows. You say 40 down, 40 up, 20 down, 20 down. You put arrows that are going down, up. So that you can do in a calculation. But you can't do it in disclosure. In disclosure, you must write the words in full, increase, decrease, and you must show us how they are basically moving, whether increasing or decreasing. Okay. So you can see that the nice part about this one is that the whole 20 and 20 and 40 here, they are decreasing. If they are decreasing, your profits will go up, right? If your profits are increasing, the tax, 30% of those figures will also increase. So the net is 20 minus 6, 20 minus 6, 40 minus 12 is also an increase in profits of 14, right? So that is what is happening there in that example, right? So those basically are your calculation, the way they move. So I usually say to people, just to show you this alternative one, I usually say to people, just look at your figures here. You'll realize that the highest figure is about 380. No? Then I usually say, assume a figure above 380, especially I usually add maybe 50,000 more. Let's say 380, add 50, takes me to 430. So, but in this exercise, I've went for 450. And I'm saying, assume purchases to be 450. You can assume any figure there above that one. Even 500,000, you can assume it, then you'll see. So now, this is what I'm doing. I'm saying, let's use the new method here. There is no opening. I've assumed my purchases to be 450. Please, if you assume a figure like this one, don't change it. You will see it's 450 here. In this year, it's 450 there. It's 450 there. Right. Now, opening 0, purchases 450, minus closing of 380, it gives me a cost of sales of 70. This closing here becomes opening here. You'll see the sign changes when it moves from closing to opening and closing. It changes the sign because that's how it's supposed to be. Then plus 450 minus 360, it gives us the cost of sales of 470. The closing here becomes opening here plus purchases of 450 minus 200. It gave us the cost of sale of 610. Right. You do the same under old. 0 plus 450 minus the closing under old, give us 110. The closing here becomes opening here, plus purchases of 450 minus closing of 300. It gives us the cost of sales of 490. The closing here becomes opening here, plus purchases of 450 minus the closing of 120. It gives us 630. Now, what is happening here? I want to move from the old, which is last in, first out, to the new. Now, let's compare. If I'm here in the old one, in 2018, I might want 10. And I want to move to the new one, which is 70. It tells me that I must decrease my cost of sales by 40. If I decrease my cost of sales by 40, the profit will go up, the tax will go up, my net is 28 after tax. Okay, if I do the same, 490, I want to move to 470, I must decrease my cost of sales by 20. If I decrease cost of sale, the profit goes up, the tax follows that same direction, and the net. Right. If I do it in 2020, 630, I want to move to 630, I want to move to 610, I must decrease again by 20. Then the gross profit increases by 20. The tax by 6, the net effect is 40. Right. So I was just showing you the same calculation in a different way. Okay, this calculation in a different way. Obviously, in this one, you must then still calculate your balance sheet movement, which is what is missing in the second one. In this one here, what is missing in the second one is that you still need to calculate this line here. Right. You must still calculate this line here, this one here. Okay, you must still calculate it. Okay, now if we then basically are here, let's then now deal with the exercise. Now I want to start by putting the changes that I need to put here. So here in number 1, here under required, they say prepare. They wanted to prepare the statement of comprehensive income. Okay. Now, you've got the statement of comprehensive income. Here is your cost of sales. What we know from the calculation is that this 400 must decrease by 20. This 425 must decrease by 20 also, because that is what the calculation is saying here. You'll see it says decrease these 2 years by 20 in cost of sales. Now, logic tells me that if I decrease 400 by 20, if I decrease 400 by 20, it's 380. If I decrease this one by 20, it's 405. Right. Here is 380 and 405. Right. Obviously, if you change those ones, then your gross profit figures, they change. They become new figures compared to this one. You can see here, this one is 600. If you change the cost of sales by 20, then the profit goes up. You see, because you've decreased an expense, it goes to 620. The same thing here, it would have changed by 20. Right. Now, in terms of this calculation explains to you that if you do that in those years, your tax must increase by 6 in 2020 and 2019, also by 6. So then we come here. Your tax is 135. If I increase it by 6, it takes me to 141. If I increase this one by 6, it takes me to 208,500. Okay, there it is. 141, 208,500, because it is stated here that once you do these changes, tax in the income statement must change by 6 in both years. All right. So obviously, once you've changed that, you'll have a new income statement as presented here in required one. You'll have a new one which will look like this. Obviously, the figures, as you keep changing some by 20, the text changes and all that, then it gives us these new figures. Okay. All right. Sorry. Now, then here in required 2, they are saying prepare the statement of change in equity on that date. Now, you will notice that in the question you are given the income statement, right? Now they give you this. These are items that go to the statement of change in equity. These two, right? But pay attention to the closing of this retained earnings that they've given you. They are saying it's closing in 2020, meaning this year here, right? 2020. Now, the first thing you must know when you want to deal with this requirement here is that you must calculate opening retained earnings. Let me show you what I'm saying. You must calculate this figure here first. This one and this one. Both of them. You must have those figures first in the statement of change in equity. But you'll notice something. These two figures that I'm highlighting, they're not given to you in the question. In some question you are given, in some you are given one and then you calculate the other one. In some you're not given even both of them. In this exercise you're not given both of them. You're given the closing here. So what you need to do is to calculate it yourself. Now, here's this calculation. Here. It says, I know my closing inventory is 847,500. Right. Now, remember, I want the opening retained earnings in 2020 and I want the opening retained earnings in 2019. So what do? You minus the profits. This profit of 315 comes from me. It's given to you in the question. Here it is, 315. And I'm also going to use this 47,500 somewhere. Okay, so just pay attention that it comes from that. Okay, there it is. Now remember, I'm going backwards. That is why I'm minusing the profit. If I was going forward, I will add the profit. But in this case, I'm going backwards. So I'm saying closing retained earnings minus 315. Right. Right. Remember, in the question here, they've shown us dividends. Here they are. So for 2020 is 80, for 2019 is 60. Remember, dividends, if you are doing them in a normal way, it's a minus when you are doing the statement of change in equity in the normal way. So you'll see they come in as a positive figure. All right. So if you say 847,500 minus 315, this minus this plus 80, then it will give you 612,500. So I've got one of these figures now, which is what I want here. I want this figure here, the opening. Here it is. Right, I'm still short of this one. Then I continue with the calculation. Always read the dates, the date in terms of what you are given in the question in terms of retained earnings, whether it's opening for what that year or closing one. So then you'll use this calculation, then depending on it. Now, since I've got the 612,500, now then I'm moving. In 2019, I will add the 60, which is the dividend for that year, and then I will minus the profits. Then it tells me that in 2019, my retained earnings was 200,000, the opening. Okay, then here I am. I've got the 200,000. Right. So that is my starting point. I've managed to calculate the two. I've got this one, and I've got this one. So usually, then what I will say to my students is that to make this thing easy, let's say you want to get this figure here, this 28, to make it easy for yourself. So this is 200 here. What I usually say to my students is that just look at this thing and say, okay, 200,000 is opening retained earnings in 2019. How many priors do you have in terms of the calculation? You've got one, which is 2018, right? One prior year, which is 2018. Then you go to the calculation and say, okay, here is 2018 in the calculation. What is my net? My after tax. Remember, we were talking about retained earnings. Retained earnings is a figure that is accumulated after tax. So you look at the after tax, you say, oh, 28,000 in 2018. It's an increase in profits of 28. Okay, I'm going to use that 28. There you go. You put the 28 net increase. So you add the 2, they give you 228. Okay, fine. Now you are here. You want to correct this figure here. Okay, you want to correct 612,500. So meaning you want to find this 42. How do you find the 42? You do the same thing. You say, okay, I'm in 2020. How many priors do I have? I've got 2019. I've got 2018. There are two, 2019 and 2018. Then again, you go to the calculation. You say, oh, how many priors do I have when I'm there? I've got 2019, which is 14, and 2018, which is 28. What is 14 plus 28? 14 plus 28 gives me 42. If I take this and I add it with this one, it gives me 42. Here we go. We've got 42. Then you add the 2, they give you 654,500. Right. Now you'll see once you've corrected your statement of statement of comprehensive income, which is your income statement, you'll have new profit figures there that you must carry to here. Right. And then you must minus your dividends declared for each year. Right. You'll notice then 228,000 plus this one minus this one will give you this one. And then it becomes your opening here, which is shown here how it's done. Right, plus 329. So this one plus this one minus 8 gives us 903. So now this is the horizontal way of presenting the statement of change in equity. I said, oh, because I know in maybe in other levels, maybe accounting 2, you were shown this thing this way, like in the vertical form. It's still the same thing. It's just you're putting it vertical in this case. You'll see it's still 200 plus this gives you 228. 228 plus this one minus this one, it gives you this one here. Right. And it's shown here how it was calculated. And then there's 329 minus 80, it gives you 903. It is the same thing as this one. The figure, this here this whole thing here is the same as this one here, except that you are presenting it, the other one is horizontal, the other one is vertical. It's still the same thing. Okay, right, we've answered number 2. Then we go to number 3. They're saying do the note. In the note, we are very fast about a few things. I'll explain them to you. There are things that you must get right. You must do them the same way that we want them to be done. So we are talking about this note, right? Number 1, in this note, you must explain to us what happened and the reason why you did that. We are saying during the year, the company changed its accounting policy with regard to inventory valuation from last in, first out method to weighted average method to provide a reasonable estimate. So you are telling us, I've changed from this to that, and the reason is this, right? But you know what is the nicest thing about this thing? You don't have to struggle to write that first sentence. That first sentence comes directly from the question. Here it is. It comes directly from the question. You just take it from the question and then you plug it. You plug it in the note. There, you plug it here. Right, you plug it here. And then after, there are marks for these things. There are marks for these things. Now, the next thing that you do, you tell us that the change is accounted for retrospectively. I've already told you that retrospectively means fix this year, then go backwards, okay? So, and then you say comparative amounts have been appropriately restated. In short, what you are saying, I've corrected this year. I mean, look at it this year. You fixed 380 here, and you went on to fix to get it to 405 here. You fixed it to 380 and then 405. So you've corrected 2020 and you've corrected 2019. So it means you even corrected a prior figure, right? You've corrected your prior. So you are saying comparative amounts have been appropriately restated, meaning you've corrected 2019. That's what you are saying to us. I've corrected 2019, I've corrected 2018, meaning the prior, right? Now, then after that, the note, in terms of this note, you are now you have to tell us what happened in the income statement. You see what I've highlighted, the net effect on statement of comprehensive income. What then also happened in the balance sheet, the net effect on the statement of financial position. I remember I told that the change in policy affects the income statement and the balance sheet. Now, be very careful. You see this one here. You are not forced to put always a decrease in a bracket. You can put your increase in a bracket, a decrease out of a bracket. It doesn't matter. As long as when I read the figures here, if I see something in a bracket, I understand what it means. I know if 20 is in a bracket, it means it's decreasing here, because that's what is in the bracket. If something is not in a bracket, it means it's increasing. The 6 is not in a bracket, that means it's increasing. Okay. Now, one nice thing about this thing is that you need to define this and show us what is happening. What I've highlighted, the cost of sales is decreasing by 20 and 20. 20 in 2020 and 20 in 2019. The tax is increasing by 6 in 2020 and 6 in 2019, which gives you the net. 20 minus 6 gives us 14. Now you see in this line, we are defining this thing in a different way. Here you'll see that you are defining it increase in a bracket slash decrease in profit slash income, meaning the after tax amount, right? It's in a bracket there. It tells me that it's increasing in that line. Okay, since it's increasing in that line, one nice thing about this part, this whole part here, let me show you this, is that you are taking this thing from the calculation and then you are plugging it there. Look at it. Look at it. Here. If you read the cost of sales line, here it is, decrease 20. Then it says tax, increase 6. Net effect, 14 increase. So, what I'm reading from this note, here is what is in the calculation. You just transfer it from the calculation to here. You are explaining to us that this is what happened in 2020, this is what happened in 2019 in relation to the income statement. Okay. Then you come to the balance sheet. You can again go back to the calculation. In the balance sheet, you are saying in 2020, my inventory must increase by 80, in 2019 by 60. Right. Here we go. Here we go. 80 and 60. Just exactly like they are in the calculation. You're saying my inventory must increase by 80 in 2020 and 60 in 2019. All right. Then we come to this one here, where there's 18,000 and 24,000. Now let me then show you. Let's start with the 18 so you can understand the 18. How did we get it? Right. Let's come back to the calculation. Let's start in 2018. What is happening to tax in 2018? It's increasing by 12. Now, if your tax increases in the income statement by 12 in 2018, your liability will increase by 12. Let's do a tier account of SARS, or SARS. We do a tier account. We label it SARS. If in 2018 my income tax expense is increasing, so SARS will have a credit now because it's a liability in the balance sheet. It must increase. Let's credit in that tier account 12,000. Right. Come 2019, my SARS is increasing by 6. Okay. If it's increasing by 6, so let's credit 6,000. Now, I've already credited 12 from 2018. How much in total now do I have? I've got 12 from 2018 and a 6 in 2019. That gives me 18 in the tier account. Right. So, in 2019, I've got 18 here. Right. How then do I get to 24 in 2020? The 24 in 2020, remember, or if I've got 6, so I've got 12 and 6, that gives me 18. If I add another 6 in that 18, let's put 6 again now under credit in the tier account. If I put 6, it will be 18 plus 6, that takes me to 24 now. Credit. Right. So it's more like you are doing the tax cumulatively. That's how you get to the 24. Right. Okay. Now 60 minus 18 gives you 42. This one, 80 minus 24 gives you 58. This one. Now let me just also explain this 42 and this 56. Okay. This 42 and this 56. You do it cumulatively again, just like we did the SARS one. 28 plus 14. By the time I'm in 2019, I've got an increase in the net increase of 28 in profits plus a 14 when I'm in 2019. So it's 28 plus this. That will give me 42 net increase in. You see, even the definition here, tells you that if it's in a bracket is an increase in liabilities and in equity. Okay. So the 42 is an increase in equity. 56, 42 plus 42,000 plus, where is it? Plus another 14, which is this one. Plus 14 gives me 56 now. It's 56 here. Right. So we're adding in that line, just like what we did with text. In text, we said 12 plus 6, we got 18. Right. Here we are saying 28 plus 14, we got 42. If you add plus 14, it gives you 56. In text, if you say 18 there and plus 6, it gives you 24. So that's how you get these figures that are here. Right. These figures that are here. Right. Let's deal with this one. And most of the students, they forget this one all the time. It says adjustment against retained earnings at the beginning of 2019. So in short, your retained earnings at the beginning of 2019, which is this one, has been adjusted by 28. You see this 28 here, right? So that's what you are saying to them. Or you can even go to the calculation and check here. It is the 28 that they're talking about. You've adjusted 2019 with 28,000, right? So usually students, they forget this one in the note. So your note is then done. So we have covered required 3. Now here they are saying calculate the income tax expense and taxable income if SARS reopen prior year assessment. So they are saying this thing in relation to this one here. When you are doing this question, it says SARS will allow the new inventory valuation method at the end of the current year. Deferred tax is provided on a compulsory basis, so will not reopen. You see here in the question they're saying they're not reopening. The new method will be accepted at the end of the current year. I think it's just duplication. It's already said here at the top, right? So now what happens if SARS says they want to reopen, meaning they allow you to use this new method going backwards, meaning retrospectively? This calculation here, so these are your profit before tax, right here. Profit before tax, right? If you come here, where is it in this question? 315. Yeah. Profit before tax here, there. Okay. That's what you have. All right. 470 and 695. No, I think I'm reading it. Oh, here. Once you've restated, okay. You have to use the new ones, the restated ones, right? 470 and 695. Okay. Now, this is what I want you to remember. You see here in the 695, what you did is this. You adjusted cost of sales. You decreased cost of sales by 20. Now, what happens to gross profit if you decrease by 20? The gross profit would have went up. It went up. So what they're saying cancel this increase in profit of 20. Right. So then you've got 470 here. What happened also in 2020 is that you decreased cost of sales by 20. The gross profit went up by 20. So they're saying cancel that also. Right. Now here they are saying to you, your opening inventory in the year 380, sorry, in the year 2019 is 380. Okay. Because you must read according to the question, they're saying the new method will be accepted at the end of the current year. So meaning they're only going to allow this figure here. The rest in 2019 and 18, you are using the old one, meaning you are using these ones according to them. Okay. According to the question. But in required 4, they are saying, how would you calculate this thing if you are using all these ones here? Currently in the question, you are supposed to use these 2 and this one in terms of the question. But in required 4, they're saying what would happen if you're using the new one all round or all throughout. Right. Now, this is what would have happened. Your opening figure here would have been 380. Your closing 360. It becomes opening here. You'll see I'm using the old one. But then when I come to the current year, the closing, then I use the new one because that's when it's acceptable according to what has happened, right? But just to make sure that people understand this thing, no, in this case, you are using the new method. Sorry, so that let's look at it here. 380 from the new, it's opening, right? 360 is closing in that here. There it is. You're only using the new ones, right? 360 and then minus this, because in this case, in terms of required 4, they are saying what will happen if the new one is acceptable to all throughout. Okay. So now, if you add all these figures here, on this column, if you add everything, gives you 0 under temporary differences. On this one, it gives you 140. 470 plus 140 gives you 610. 695 plus 0 is 695. If you multiply these by 30%, here they are. They give you 183 and 208, 500. Right. And then the deferred tax, if 140 is positive, it means it is deductible. So if you multiply it by 30%, it gives you 42. So the total of the two is 141 here. The total of this one is 208. You'll see it agrees to this. Right. It agrees to that. Right. Let me show you this calculation here in relations to the question, how the question is structured, meaning in relation to what you are reading here, how it's supposed to be in relation to this one here, in relation to this line here, how that calculation is supposed to be. Okay, this is what should happen. Here, you'll replace this one with 340. Right. This one here becomes 300. I'm reading these figures from here. Old. I'm following the question. So if I do that, I will then get a 20,000 like this. Right. If I then get a 20,000 like this, this one changes to 715. Right. If then I take 30% of that 715, it will give me 214, 500. Now, I've got 20 here. 30% of the 20 will give me 6. But remember, it is positive that amount then. It is positive that amount there. That will give me a figure like this. Right. Still 208. If you say 215, if you take this minus this, it still gives you the 208, like the one in the question itself. Okay, it still gives you the 208. Then you go to the following here. It's 20. This one, remember, this closing here becomes opening here, so this one must be 300. Okay, and then the next figure here will be 200,000 because now the new method becomes acceptable here according to this, right? So if I add all these figures, 80 here. Okay, it's 80. If I add 80, that gives me 550. If you take 30% of 550, it gives you 165 here, right? Then 20% of this 80 will give me 24. Right, 165 minus 24 will give me 141 still, you see. So this one is in relation to the question. This is how it's supposed to be. And this is how you get it in relation to the question itself. But then in relation to required 4, you'll see that not everything here is supposed to look like that. Okay. I'm just trying to put it the way it was, how it was happening here. I'm hoping now I'm in the right space. No, because that will be 3 minus this one. That gives me something else. So let's just do this. Yeah, now it looks fine. No, I don't think it does. Anyway, and maybe just put it the way it was when I was showing the other method. So I want no, reverse. Yeah, it's 24. It's supposed to be like this. Right. So that was your number for calculation. So we have done this exercise, I've showed you how to do all these steps up until here, the calculations, these ones, even this one and that one, right? Even how you reason in terms of a simplified exercise in relation to this, right? So thank you for sharing and viewing this video.